Matthew.
All right. This is Investing for Beginners. I'm Matthew Heaney. Let me just, these fancy, I like these fancy animation slides. You'll have to teach me how to do that. So I'm an engineer at Google. I'm a software person. And I'm a software person who happens to have an interest in finance. It's a bit of a hobby. And there's a group within Google called Finance Works. And we write applications used by the people in Google who are actually people who work in finance, and they use our tools to help Google run its business. And I don't know if you know this about Google. There are a lot of community groups in Google that they're not strictly work-related. So if you're a person into motorcycle racing or heavy metal music, whatever, there's a group for it. And at work, there's also a group for financial planning. And I happen to, that's a kind of a hobby for me. So I'm active in this group, and we're among the largest groups at Google. So we talk about 401ks and planning and where to get life insurance, things like this. So basic personal finance things. So that's a little bit about me. So today we'll talk a bit about sort of the intersection of, it's how investing fits within the context of retirement planning. So here is, I like this diagram. It's from Michael Kitces. And if you've done any, if you've ever done a Google search for personal finance information, you've definitely hit, you've hit his website. And I like this diagram that he made because it kind of puts everything in context. And the basic idea is when you're working, you have a certain lifestyle, and there's a certain amount of money you require to fund that lifestyle, but you have a certain amount of income in excess of that lifestyle, and that's the money that you need to invest so that later when you leave the workforce, since you no longer have income from labor, you're going to be taking your income from the money that you saved. So that's why you save in order. This line here, this horizontal line in the middle, is just saying that we assume that you want to maintain your lifestyle in retirement. You know, some people that don't save, they go from this top line and they do this vertical drop, and then they live on Social Security, and they have to really reduce their standard of living in retirement. And the idea here is, in order to maintain your lifestyle in retirement, you need to be saving a portion of your salary. So I like this diagram because it kind of creates a nice framework for thinking about these issues. So anyway, a guy named Bill Bengen, he was a financial planner who I think was he had an engineering background, and he went into financial planning. And for a typical retirement of about 30 years, he was kind of curious. He was wanting to know, well, how much money do I need to save so I have a strong guarantee that I don't run out of money? And he did an analysis of market history, and he came up with his conclusion was, if you save about 25 times your desired salary, then that means you'll have a very strong guarantee that you won't run out of money. So the way that works is you save a pile of money, and if you take the pile of money and divide by 25, that gives you 4%. So he says that, just like when you enter the workforce, you get a job and they give you a salary. Well, when you enter retirement, you kind of get a salary, and the salary is coming from your portfolio. So what you do is you take that initial pot of money, and you take 4% of that, and you say, all right, that's my salary for year one of retirement. And then every year after that, you inflation adjust that original number. So you have an inflation adjusted salary while you're retired. And he did an analysis and said, you know, if you do this, if you take your distributions that way, you have about a 95% chance of not running out of money. And here's a diagram that looks more scary than it really is. But if you look at all the possible outcomes, this here off on the left is where you're starting. This is like year 0 of your retirement. And if you look at all the possible, because markets are, markets aren't predictable, and you don't know what the market conditions are going to be necessarily when you retire. But he says, among all the possible 30-year retirements we've been able to look at, how much can I withdraw such that I have a high probability of not running out of money? And that's what this 4% means. He says, if you take 4%, you get a small number of outcomes where you start to run out of money. And he says, well, that's a kind of acceptable compromise. So this is how he came up with 4%. Now, if you were to withdraw less, then that would have the effect of pushing these failure outcomes off to the right. And so below a certain withdrawal amount, you essentially have no outcomes that fail. Essentially, your money would never run out. And when you start getting below 3.5% or so withdrawal rate, then it's like you almost have a guarantee that you won't run out of money. But in order for your withdrawal amount to be small, it means you have to save more. So that's the trade-off. And likewise, if you were to withdraw an amount greater than 4%, then that would have the effect of pulling these failure outcomes off to the left. So you're increasing the probability that you'll run out of money. And when you start getting above 5%, then you start to really increase the possibility that you can run out of money. So use 4% as a starting point when you're doing your planning. So anyway, you need to have a goal. So if we have, I'm just making up some numbers here. The average salary in the U.S. is around $60,000. So let's use an average salary. So in that case, you'd be shooting for a target, a savings goal of around $1.5 million. So 60,000 is 4% of 1.5 million. Now you might think, oh my God, that's how would I do that? So don't panic. Don't panic. All this, you can do it. You can do it. It just means that you need to make regular contributions to your 401k and to your retirement accounts. And if you do that for over the course of your career, then you'll have no problem hitting these numbers. And I say here, you can use a spreadsheet to do your planning. It's actually what I do. And I have some things in the speaker notes that can help you do that. So anyway, here's some examples, and we'll be talking more about these accounts a little later. But you have an IRA and a Roth IRA that allows you to save $6,000 a year in a tax advantage account. And a 401k, the elective deferral contribution limit is $19,500. So if you had saved the maximum value in your IRA, so this is $6,000, the light green. If you save $6,000 a year, and we assume a 4% real return from a portfolio, which is a reasonable real return from a portfolio. You can hit around, if you do that, if you enter the workforce when you're 22 and you retire when you're 67, that's 45 years. So we can kind of use that as a benchmark. And if you save $6,000 a year and you do that for 45 years, when you retire, that puts you out to around $700,000. So that's a nice chunk of change. And if you do, see, go ahead.
Sorry, there's just some questions in the chat.
Oh,
Someone asked, can you please talk about which index funds to put in your Roth IRA?
oh, that's coming up.
Oh, perfect. Okay.
Yeah, I have a whole section on that.
Okay, perfect.
You're way ahead of me here. So yeah, that's coming up. And so again, if you save the maximum in your 401k, that's 19,500, and that's just ignoring the company match. You know, that takes you out to about 2.3 million. So I said before, 1.5 million. Oh my God, that's a lot of money. But over the course of a career, if you make regular contributions, you can hit these numbers without a problem. But it's up to you. You have to save. You have to do it. I had said in the speaker notes, this is America. It's up to you. No one's going to do it for you. So that's how it is. So the takeaway message, I've broken this out by decade, and the takeaway message from this slide is that the more you save, the more you'll have, and the longer you save, the more you'll have. Because the whole way this works is by the magic of compound interest. But you have to give compound interest a chance to work. So if you delay, that's going to reduce your final savings goal. So I really tell people, like, when you're in your 20s, oh my God, save as much as you can, because that's going to really power your capital later. So anyway, I say here, we're kind of what we already said. There's no magic here. You don't need to be a stock picker, or you don't need to go getting stock tips on Wall Street bets. All you need to do is invest in your 401k, and you do that every year you're retired, and you'll be fine. So what I say here, if there's something called the rule of 72, if you assume a nominal return, which includes inflation, if a nominal return of about 6 to 7%, that means your wealth will double about every 10 to 12 years. And likewise, if every decade that you delay is going to reduce your final wealth amount by by half. So I really stress to people, like, especially like people join Google and they're right out of school. I say, please, please, please fill out your 401k. If you can do that, you're going to be really happy later on. So anyway, your goal, and again, I'm kind of putting this putting this in the context of that framework, is the idea. There's this idea from finance of human capital. Is that you enter the workforce, so your labor is worth a certain amount of money. So when you start the workforce, your human capital is at a maximum because you have the maximum number of years while you're still in the workforce, but you're starting with zero money. So as you work and as you live your life, you have fewer years remaining in the labor force, so the value of your human capital is decreasing. But the whole time you're doing that is you're saving, you're investing in your 401k, you're investing in your IRA. So the amount of your human capital, the amount of your financial capital is increasing. So eventually what happens is when you're retired, if you remember that first diagram that we showed, your salary when you're retired is coming from your portfolio. So the whole game here is that you're gradually replacing your human capital with your financial capital. And the idea is that when you're retired, your income is going to be coming from that financial capital because you have no more labor income because you're not working anymore. So we can divide your life into two phases. There's the accumulation phase. So when you're in the workforce, your goal is to be saving this big pot of money, about 25 times your desired retirement salary. So during the accumulation phase, you're optimizing for capital growth. And I'm telling you, this is where we start talking about stocks. This is why you care about the stock market. So you care about the stock market because it gives you a return that's sufficient for you to save enough for you to retire. So that's why you're doing. That's why you care about the stock market. It's because you're trying to invest over the long haul, and you get a nice return from the stock market. And then once you retire, you kind of switch over to what we call the distribution phase, is where you're spending down from your portfolio. And I say this because, you can have a long retirement, potentially 30 years or more, and you need to preserve your buying power. So you still care about the stock market when you're retired. It's just, but in that case, it's not really for growth. It's you need some risk, just to compensate for inflation, in order to maintain your buying power. So anyway, here is a diagram, and I made this diagram. It kind of looks like Star Trek, but I didn't think of that at the time. So this is, if you take your 401k and you use 4% growth assumptions, and this is what it looks. This is what you could. I made this from a spreadsheet. I recommend that you do the same. So you're saving, and then you retire when you're 67, and then you're spending down according to this rule I gave you earlier. And the idea is that you're spending down your portfolio, but you're doing it in a way such that you won't run out of money. So presumably, I'm assuming this is 35 years, I guess. So the whole thing, the whole problem, the worst case scenario for you is to be retired and then to run out of money. I mean, that's a bad. Then you'd be in a bad place. Now these numbers, these are arbitrary numbers. They happen to coincide with the values of your IRA. If you had saved 6,000, that would put you out here. If you had saved 19,500 every year, that would put you out here. But keep in mind, you have to figure out, well, what is the curve for you? And the only way to know that for you is you're going to have to know something about what your salary looks like, and they're going to have to take that number and multiply by 25. That's why I said you have to work backwards. So you're going to have to do some planning and you're going to have to learn about what it's going to cost to fund your lifestyle. So anyway, I wanted to say something, one more thing before we start talking about risk. I learned of this taxonomy from a guy named Larry Swedroe, who he's written some great books. I recommend his stuff. And the idea is that we just showed you a diagram. You're starting from zero, and you need to get to a point where, maybe you need to save $2 million. So you have a high need for risk. And so you need enough risk in order to have a rate of return that's sufficient in order for you to save enough. And as a young person just joining the workforce, since you're not taking distributions, you have a high capacity for risk. So about every 10 years, the markets go haywire. But you, as an accumulator, you're kind of indifferent, because I mean, you care about what's true in 20 or 30 or 40 years from now. So you have a large capacity for risk, so you can tolerate market swings. And there's something here called behavioral, which is an important dimension. It's about temperament, and this is really going back to your personality. And the reason we talk about is what is your temperament for risk is what will you do? I just said markets come under stress about once every 10 years. And so how will you react when that happens? And if you're a person that is going to panic and sell all your stocks when the market bottoms out, And then you say, "Oh my God, I'm nervous. I'm nervous." And then you sit on the sidelines waiting for the markets to come back. You can really damage your wealth accumulation when you do those things. So you have to understand yourself, and you have to understand what you might do. And so in this particular case, maybe for you, the answer is have more bonds. And when you have bonds, like the more bonds you have, that tends to moderate the wild swings. So some of these things you have to understand yourself, and it's really important to understand yourself and understand how you'll react when the markets come under stress, because it will happen. It happened a year ago, and I hope you all remember. And it made a lot of people very nervous. And we had long talks on the forum at work about, I was me trying to talk people off the ledge. So I say here, investing is simple but not easy, because we're not robots, we're humans, and we react in ways that are sort of often detrimental to the accumulation of wealth. So anyway, here we are. What's a stock? A stock represents a partial ownership of a corporation. So when you buy a stock, you're becoming an owner. And as an owner of a corporation, you become entitled to a share of the profits. And you've heard of a stock exchange, and stocks are bought and sold on an exchange. And companies vary in size. That's called the market capitalization, or market cap. So you have large cap stocks and small cap stocks, and you have price to book ratio is kind of a measure of the value of the company relative to the stock price. So there are value companies where the stocks are priced cheaply, and you have growth stocks where the stocks are kind of expensive. So those would be growth. So like Google is a large cap growth stock. Value stocks are kind of like your utilities. So a company's stock price is determined by the market. And when financial analysts, they say, well, we think this company can make this much money, so we think that we can value a stock this way. But there's also a behavioral component called the PE, the price to earnings ratio, and it says, well, how much am I willing to pay for a share of those earnings? So that's how stock prices are determined. So there's another asset class called a bond, and a bond is just a fancy name for a loan. And you loan money to a company, and then it pays you back. And bonds are bought and sold at a bond desk, and there are also auctions. And bond prices move, but they move by the prevailing market interest rate. So bonds pay it's called a coupon. So if you have a coupon, if the bond coupon is greater than the market interest rate, then your bond is valuable and it commands a higher price. And then and the opposite is true if your coupon is less than the market interest rate. And then there's another dimension of bonds called credit risk. So if I loan money to somebody, there's a chance you won't get paid back, and you have to compensate me for that risk. So that's credit risk. So there's a possibility for default. So anyway, this kind of summarizing what we've just said. Prices stock prices are volatile because of changes in market conditions. And you must be compensated for this risk, and you get a higher return from stocks for that reason. And bonds have price volatility for a different reason, because of changes in market interest rates. And you are compensated for this risk. If I loan you money for 30 years, it means you're going to have to pay me a higher rate, a higher coupon than if I loan you money for 5 years or 1 year. So you have to, that's a term risk, and you have to compensate me for locking up my money for a longer time. And the thing is that stocks vary more wildly than bonds because bonds is kind of a mathematical thing. So the stock prices are kind of determined relative to bonds. So, for example, if I had an investment that had a 4% return, and they said, would you rather the asset be a stock or a bond? It'd be much better for you to invest in the bond because the bond is like it's mathematically determined. It's a contract to say we'll pay you this much money every 6 months. So a stock, since stock prices vary more wildly than bonds, I wouldn't accept 4% as a return from a stock if I could get a bond for 4%. So stocks, you have to compensate me for taking that additional risk, and that's why stocks have a higher expected return than bonds, because they have a greater risk. They're more volatile. So you have to be compensated for this greater risk, and you're compensated by having a higher return. So always have to be thinking about risk and reward, and that if you take risk, you have to be compensated for that risk. So that's stocks and bonds. Now, a mutual fund is just a pool. Everyone buys stocks in aggregate. So a mutual fund just pools the money from many individual investors. So you have stock funds that invest in stocks. You have bond funds that invest in bonds. You have balance funds that do a mix of both. And the thing about funds is that there's usually a defined strategy. So you might have, we'll be talking more about total market index funds. So you might have a fund that invests in the whole stock market. You might have a fund that invests in some corner of the stock market. You might have a fund that invests in US government securities. So that's how you characterize a fund. So an index fund, and I'm sure like when you've listened to the radio or whatever, they say, oh, the S&P 500 hit 3,200 today, or the Dow hit 19,000. And those are indexes, a market index. And an index mutual fund is a fund that it tracks the behavior of a market index. So it's not some guy who's a financial analyst that's saying, hey, I think these stocks over here, I think they're going to do better, so let's buy those stocks instead of these ones. That's not how index funds work. Index funds is kind of like run by a computer, and it strictly tracks the index, and that's where you get. So you get the return of that index. That's what the index fund does. So I gave a couple of examples. The S&P index fund, the Wilshire 500 is another index that tracks all the publicly traded stocks, and they're very inexpensive. Always when you buy a fund, and we'll be talking a little bit more about this in a second. Funds have a fee, and you need to know what you're paying. Always understand what you own and understand what it's costing you to own it. And index funds have the virtue that they're very inexpensive, and you care about this because the higher the fund, the higher the expense of the fund, the more that puts a drag on your return. So the higher the expenses, the lower your return. So always be thinking about that. And something here, well, maybe we can talk about it later for taxable accounts. But broad market funds are very tax efficient. The stock funds, so they don't trade in and out of stocks. They don't have big taxable distributions, so they're very tax efficient. So if you ever were going to buy an active fund, which is the opposite of an index fund, but an actively managed fund, they tend to be tax inefficient. So you want to keep those in your tax advantage accounts. So anyway, a note here. We kind of alluded to this earlier when we started. Really prefer index funds to individual stocks. The thing about a stock is that stocks have what's called idiosyncratic risk. And you're not compensated for this because you can, if you just bought a plain old mutual fund, you can diversify away the idiosyncratic risk, so that you're not compensated for taking this risk. So that's why it's really not in your favor to be buying individual stocks. Really, the purpose of an individual stock is to determine the market price. But you, as an index fund investor, you can buy the index fund knowing that you're getting the right price. So what I say here to you, it's like, please, 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 don't be a stock trader. Just stop it. Just be a long-term investor. Just buy and hold, and you'll be fine. So make index funds the core of your portfolio. Now, I will say this: if you really want to invest in the stock market and you like to do stock investing, fine. But you need to give yourself a kind of budget. So maybe allocate 5% of your portfolio to individual stocks, or 2% or 3%. But it should be some small corner. But the core of your portfolio should be built using index mutual funds. So anyway, we've kind of alluded to this before. How do we characterize these funds? And people will ask, the question that came up earlier is, what funds should I put in my account? And this is going to help answer that question. So we've talked about the two dimensions of a stock fund, which is the style dimension and the size dimension. So up here you have these big large cap growth stocks like your Google and your Apple and your Facebook, etc. And you have your value funds, which are more, like I said, they are more like where the stock price is a little, it's sort of smaller than the value of the company. And these tend to be your funds that are they're more well-established companies like utilities. Maybe they pay a dividend. They tend to be very, value funds tend to be, well, at least large cap value funds, they tend to be very mature, very stable. All your growth funds tend to be your big tech stocks. So this is how you would characterize, these are the dimensions that you would, how you would characterize a stock fund. And all of these boxes collectively, that's the total market. And I put some of these links, I got this diagram from the White Coat Investor blog. That's Jim Dahl. This is actually a good article, but go to his website. He has lots of good information there. He's a doctor. That's why it's called White Coat Investor. But he's just like me, I'm a software guy. He's a doctor that got into this stuff, and he has a lot of great stuff. So let's put some numbers here. Here is the style box, and if you look at the total stock market fund, this is VTSAX. This is a total stock market index fund. Here are the sort of relative contributions. So you can see here, the large cap, that's that top row, that's over 75% of the market. And you've got your mid caps and your small caps. So these all, I added these add to 100. So this, you can see that the total market index fund is just buying everything. It's buying all the boxes. That's what that means. So here is, I hope everyone can see this all right. I went to Vanguard to get this. So when you're getting information about a fund, definitely go to the website of the fund and get the information. So I got this at Vanguard, and I recommend you read the prospectus. You can download the PDF. So the takeaway message here is, look at this expense ratio. You have, this is 0.04%, and when you're buying an index fund, you want to be buying something that's south of 0.1%. So this is a basis point is how we say it's 1/100th of a percent. So this is 4 basis points. So this is good. This is good cheap fund. That's a good number that you're looking for. And you can see here, this is high risk, so more reward. And that you as an accumulator, I said before, you have to be saving, 1.5, 2 million. Those are the numbers you're looking to save. So you need to be, as a young accumulator, you need to be taking risk. And this is a really good fund. So this total stock market fund should be the core of your portfolio. So here is the Vanguard page where they show the style box. Now this particular box is a bit misleading because it only puts color in one box, but really all of these boxes are in force here, and you can see it buys the whole market. This about 3,500 stocks in the U.S. market. So but this is really describing the footprint. It's really considered. It behaves like a large cap blend. Is the general idea. And here's another place to get a good information is at Morningstar. And they kind of break out some of the information about you'd find in the prospectus. But this here, the blue line here here's the style box again, and the blue line is the fund. And this is kind of telling you, because this is a total stock market fund, it's showing you that the footprint of this fund is a little larger than something that would be strictly a large blend fund that only invests maybe in this top row. So you're getting everything. So that, again, VTSAX, or this, I'll show you there's a Fidelity option that's similar. So again, we can do the same thing for bonds. So you can characterize bond funds along two dimensions, that your sensitivity to interest rates and your sensitivity to credit quality. So this top row, you have high credit quality. That would be your U.S. Treasuries. And there's no risk of default, so you have high quality here. And somewhat lower is where you have investing grade corporates. So there's a theoretical possibility that they could default. So you need to be compensated for that risk. So along this row, you'd be getting a slightly higher return. And this bottom box, the low quality, these would be your high yield funds, which is a nice name for junk bonds. And if you're going to invest in a junk bond, they're going to have to pay you a lot of money because there's a strong possibility that they'll default. So you have to be compensated for that risk. So again, this is a style box. And for you as a long-term accumulator, you're going to be in here somewhere in the intermediate term. So these are your short and limited term duration. So this is maybe 1 to 3 years, something like that. But you as an accumulator, you're going to be sitting here in the intermediate term spot around 5 to 7 years. But let's just keep looking at that. So here's, again, I went to Vanguard. This is their total bond market fund. And again, they're characterizing the sort of footprint of this as it's high credit quality, because it tracks, the total bond fund tracks something. The index for this fund, the index is called the Barclays Aggregate Index. And you can see here there are about 10,000 bonds in that fund. And the thing here, is definitely look at the style box, and the important number for you is what is the duration. And this duration is a measure of the sensitivity to interest rates. And so you want to be, as a long-term investor, you want to be around, this is a good number, around 6 to 7 years, where you're getting a high enough return for your growth needs. So anyway, here's the similar information that you would find at Morningstar. And they've characterized this. They put the box right in the middle. But yeah, this is just this similar information. But yeah, so definitely go to, when you're getting information, go to Morningstar, go to Vanguard, go to Bogleheads. But Bogleheads, you don't know. John Bogle was the founder of Vanguard. He's the guy. John Bogle is the guy that invented index funds. So there's a lot of people that follow his investment philosophy, and it's what we do at Google. So what is a portfolio? A portfolio is a diverse group of investments, and it's designed to manage your risk. And I like to use the analogy, it's like when you bake a cake. A cake has flour and it has eggs. And you don't, when you eat a cake, you're eating a cake, it's the mix. Like when you order cake in a restaurant, they don't come out and serve you a plate of eggs and then come out and serve you a plate of raw flour. They mix them together and they bake the cake. And that's what a portfolio is. It's like baking a cake, and you put funds in the portfolio. And one of the things you want to be true of the funds in your portfolio is that they have low correlation. So how much do they move together? So you want to diversify across markets. So that would be the US markets versus non-US markets. You want to diversify across asset classes, that's stocks versus bonds. I said this before, you want to use index funds as the sort of the core of your portfolio. It doesn't preclude you from making some side bets, but index funds should really be the core. And I say here, pick an asset allocation. Don't try to time the market. Don't be a trader. Just buy and hold. And when you have a fund that's falling behind its target, when the next time you make a contribution, buy the funds that are behind their target. So this is just a diagram. This is from Callan. Callan is a financial group that helped design the Google 401k, and they publish this periodic table every year, and this is the most recent one. This is just to show you that if you look at the orange, emerging, if you remember during the aughts, you had the BRICS, which were the Russia and Brazil had really good years where they were dominating the markets, and then for a few years they fell out of favor. That's this orange here, and then they came back in 2017, and then here a real estate investment trust. So for few years, REITs had a good year, and then they kind of fell out of favor. And then when the BRIC countries and these emerging market countries, when they fell out of favor, it was the U.S. large caps came back in a big way, and they dominated for a few years. And you can see last year, small caps had a great year. I was looking, when I've been looking at my portfolio, it's like, oh my God, my small cap funds had a great year. But of course, I also own a REIT fund, and my REIT fund had a negative return last year. And that's the point. You don't know what's going to happen, so you need to be buying the whole market, because you can't predict how the market is going to behave, because markets incorporate new information. So you need to I'm hopefully driving home the point that you need to be invested in the whole market. So here are a few examples going back to what the original question. Here's an example of a three-fund portfolio where you have, this is an 80-20 ratio, and they have the 80%. So here they have a 20% allocation. 16 divided by 80 is 20%. So they have 20% in non-US stocks, which would be 60% let's see, did I get that? 20 plus 60? Yeah, that's right. 60% US stocks and then 20% in bonds. And this is over here, they have these model portfolios at Bogleheads. And here's another example I got from another website from Harry Sitt, another great website. So I like his diagram here where he shows how they broke out stocks. I wanted to say here that Vanguard wrote a white paper saying what's the optimal allocation for non-US stocks, and they said in the range 20 to 40%. So here's a number where they happen to take the middle number. So you're going to be thinking, you have a 60% stock allocation, but within that 60%, you're going to have some fraction that's U.S., some fraction that's non-U.S. So 70-30 would be typical. I myself, I'm 60-40 U.S. On non-U.S. I'm 20% bonds. You, as a younger person, maybe you want to be 10% bonds. But anyway, here's another example. Coffee House. This is a guy. His name is Bill Shulfeis. He wrote a book called Coffee House Investor. He is, I think it is because he's from Seattle. Isn't Seattle where they have all the coffee shops? So he wrote a great book called Coffee House Investor, and I recommend all of you who are trying to learn this stuff that you read this book called Coffee House Investor. It's a short book, an easy read, and everything I'm talking about today you'll find in that book. I really recommend that book. If you, I always tell people when they say, "Oh, I want to read a book," what one do you recommend? It's this book by Coffee House, the Coffee House Investor by Bill Shulfeis. And I wanted to show you this because he's doing there's something called tilting, and there's a theoretical reason for thinking that adding a bit of value tilt to your portfolio will give you a little extra return, and so that would be another way of doing this in your portfolio. So this is called value tilting. So anyway, you can see these model portfolios. These are called lazy portfolios for reasons we don't have time to talk about. But again, you can find all this information at Bogleheads. Moving on. Okay, good. We're getting near the end. I think we have enough time. So the government is providing two incentives. They really want you to save, and they incentivize you to save by giving you these accounts where they're tax-advantaged accounts, and they're accounts where if you put your money, your labor income, into these accounts, you won't pay tax on your earnings. So they're incentivizing you to save, but a characteristic of these accounts is that you have to have labor income. So if you want to have, if you want to be able to put $1,000 in your Roth IRA, when you do your taxes, you have to show that you actually had $1,000 of actual labor income. And you know, if your grandmother gives you $1,000, you can't just turn around and put it in your Roth IRA, you know, unless you happen to have $1,000 of income that year. You know, the government doesn't care where the money came from. They just need to see that you had at least this amount of labor income for the year. So you have, we'll be talking about which kind. So the general idea is that your earnings on your contributions are not taxed, and these are good places to hold investments that are not tax efficient. Bond funds tend to be tax inefficient, so these would be a good place to store those funds. And if you don't happen to have a job, but you still have some money you want to save, you can still save in a taxable account, of course, but you have to be a little more careful because you will get taxed on when you sell. You pay capital gains. Oops, sorry, that was my 50 minutes. We're near the end, so we're kind of on track here. So you just have to be a little more careful. You need to be investing in funds that are tax efficient. So total stock index funds tend to be very tax efficient. So those are good candidates for a taxable account. So again, briefly, you have a traditional IRA, and those are pre-tax accounts. So the way to think about that is the government is a co-owner. So when you take a distribution, you get taxed, but that's a way of returning back to the government its share of your account. And a Roth IRA is you pay taxes before they go in. And this is if you can hit the limits, if you're able to hit the contribution limits, think about using a Roth IRA because if you do the math, that represents a higher pre-tax amount. It's kind of subtle, but if you can hit the limits, use a Roth. But if you can't, just use a pre-tax. It's okay. And when you join the workforce, you'll get access to a 401k. And the nice thing about a 401k is employers match your contributions, and different employers do a different level of match. I work for Google. We happen to get a 50% match, which is very generous. So that's free money. So when you join a company, always contribute enough to get the company match, because that's free money. I mean, if someone's going to give you free money, take the free money. So always get the company match. So when you join a company, join the 401k and get the company match. And again, we talked about pre-tax accounts. And so maybe two more slides here. So you can create taxable accounts at many places, including Vanguard, Fidelity. You have ETFs, and ETF is like a stock. So if you happen to have a brokerage account at Fidelity, and VTI is the ETF version of VTSAX, which is the total stock market index fund. So you could hold VTI in your brokerage account at Fidelity. That's no problem. Or you can hold it at Vanguard, of course. And oftentimes, this is the mutual fund version. This is VTSAX. And VSKAX is the total stock market index fund. So it would be the Fidelity version of the VTSAX. So usually it's a little harder to hold the mutual funds at a different place. So if you want to hold VTSAX, the mutual fund, you could hold it at Vanguard. Otherwise, maybe you could hold this other fund if you have an account at Fidelity already. But if you have an account at Schwab, they have a total stock fund. And so this is the last slide. So saving. I said before, you have a goal. I said your goal is maybe you're going to shoot for 2 million. So you need to save, and this is America. It's up to you. No one's going to do it for you. So you have to do it. You have to save. One of the things that when I really got religion about personal finance is one of the concepts that really was kind of a shocking idea for me is just give every dollar of income a job. It should never be the case that you just get some money and throw it in an account. You should always have some sort of task. Every dollar of income is kind of assigned to some savings goal. And that's what a budget is. You need a budget in order to plan how you're going to allocate your income, plan your spending. So that's the idea, is you have to prioritize among all your, you can spend your money a million different ways, but you don't have unlimited income, so you have to prioritize, and that's why you use a budget. A budget is simply a means of prioritizing how you're going to spend your money. So automate your saving. A lot of times when you join a company, a lot of times you'll be it's opt out now. So when you join the company, they'll automatically put you in their 401k, and that's good. Usually, though, they put you in at a contribution level that's too low. Usually, you want to bump that up. But automate your savings. So like I fill my accounts, but I also make some taxable contributions. But it's all automatic. I set it up at Vanguard. It just takes money out of my account every couple of weeks. So be frugal. Don't be wasteful. You want to have the less you spend on junk, the more money you'll have to invest. So practice frugality, plan to save at least 20% of your income, probably more. And again, have a bias towards saving. Don't sit on the sidelines. You don't want to be out of the market. Like if you say, I don't know, this is complicated, I don't know what to do, just don't be that way. Be in the market. And if you don't know what to do, don't panic. Buy a total stock market index fund or a target date index fund. A target date index funds kind of buys one of those model portfolios we looked at earlier. So that would be something that you could do. So be in the market. And so that's it. That's my talk. So we can stop there.
Thank you, Matthew. Does anyone have questions? I saw